Okay, so this class is starting from the very basic aspect of financial reporting. Now, when we deal with the framework is examined for 10 marks in your exam. But for corporate reporting, there are 3 aspects of the framework, and we'll be doing all the 3. For one of them will give us the basic, will let us appreciate the essence of everything that we are doing. And so I'm going to start. So I will do the framework 3 on daily basis. So I will do day 1, I will do one of the framework, day 2, another framework, then day 3, another framework. So I expect that by Thursday, we should be done with the framework. And Friday, we will zoom into the past questions that have come so far under the framework. So that is what we want to do. All right. So we start with what we call the conceptual framework. So the frameworks we have, the conceptual framework, we have the regulatory framework, then we have the ethical framework. So at corporate reporting level, this is the one that they examine, 10 marks. They will bring you a short case for you to apply the ethical framework to it, and it is 10 marks. But I'm going to start from conceptual framework because it will help you appreciate. If you don't know your conceptual framework, if you don't understand the conceptual framework, it makes it very difficult for you to understand anything that we do in the standards. Yes. So let's look at the conceptual framework. Now, what is the conceptual framework? What is it all about? This is English, so you pick out the meaning from the word. So concept framework, concept framework. Now, what is a framework? If you look at the doors in your house, you will see that before you can open the door, there is a wooden structure which the door is pinned to. There's a wooden structure. Sometimes on top of it, you can have some bars. You can even put your hand there. Some people drop their keys there. But in between the wooden structure and you leaving your room is the door. So the door is hanging on the framework. And we call it frame, no? Frame, no? Frame, no? If you look at your window, it is these days that people don't do frames. These days, people use the metal guide and insert it in the block. But if you look at the olden structures that we used to have, they will do a window frame and fix it in there before they even fix the window itself. So that thing you see is what we call a framework. That is what we call a framework. Now, when you bring it to the concept of financial reporting or corporate reporting, what we are trying to say is that there has to be some reference to what we are doing. So in essence, the theoretical principle, the foundation of all our standards, everything we are doing as per financial reporting, everything we are doing as per financial reporting or corporate reporting comes from the framework. So there is no way you can leave the framework and go and do any other thing. As I'm talking to you, if there is a standard that we want to develop, any accounting standard, please, if it gets to a point where my voice is not heard, let me know. If there is any standard that we want to develop, okay, we have to make reference to the framework so that we can be able to develop the standard. So the framework is very, very important. The framework tells us what should go to the P&L, what should go to the SOFP. The framework tells us what is an asset, what is a liability, and all those things. So if you don't get the meanings of these things from the framework, you realize that going forward, it becomes a little difficult for you to understand, oh, is this an asset or is not an asset? Now, so the framework is just what we call a theoretical principle. It's a theoretical principle. And it is this principle which forms the frame of reference, which forms the frame of reference of our financial reporting. So where we can go to and say, this one said this one said this one is this, is the conceptual framework. As a matter of fact, the framework tells us what we should record. It tells us what should be recorded. So, like I said, if the framework tells us what should be recorded and you really don't understand the framework, then going forward, what to record becomes a problem. Number two, the framework also tells us what we should record. So what we should record, how should it be measured? So if you don't know how to measure it, it's a problem. And how to recognize it. So that is what the framework does. So if you miss the framework, it will be very difficult to know how to measure what you are recording and how to recognize what you are recording. Then number three, the last thing is that the framework shows us how we should communicate it. That is what we call disclosures, okay? All right. So it answers the question, how should it be communicated? So these are the fundamentals that we need to know, all right? So now if I ask you that, what is the purpose of the framework? You should be able to deduce from this thing that we've done and talk about it. All right, so let me just give you, we are doing corporate reporting. And so I am trying to give you the meaning of the conceptual framework. If it were to be normal financial reporting, we'll go deeper in terms of the advantages and the disadvantages and all those things. But at this level, nobody is going to ask you what are the advantages and disadvantages of framework and stuff. No. So what my purpose is for you to understand that there is a framework and that the content of the framework is the basis of whatever we will be doing in terms of financial reporting and corporate reporting. So right now, you know that there is a framework. So that is good for you to obtain. Now, let me just add. So the purpose of the framework, as we have discussed, tells us this is the framework. This is the theoretical foundation. This is the principle on which we develop standards. So we can say that the purpose of the framework is for standard development, the IASs and all. And since it's the framework, it also helps us to evaluate what we have done, the evaluation of the standards. Okay, standard development and evaluation helps us to do that. And it also assists us in terms of our understanding of financial reporting and interpretation of it, because it tells us what we should record, how we should record it, or how it should be measured and be recognized, and how it should be communicated. So if that thing happens, then it means that it assists us to really understand and interpret the IFRS or the IASs. All right. So these are some other things. We can add that it helps promote harmonization. It helps the auditor to express his opinion, because the auditor will definitely have to understand what to record, how should it be recorded, and how it is communicated. If it is not done so, that is where they can say that the thing is not true and fair and all this. All right. So basically, that is that. Now, so now what you see is that when it comes to, of course, you can get some advantages and disadvantages. Like we've discussed, out of what we discussed, you realize that the standard, that's the purpose of the standard, or the purpose of the conceptual framework becomes part of its advantages and its disadvantages. So I'm not going to go into all those things today. But the key word I need to bring to your attention before I go into the content of the conceptual framework, what we are doing today is really the content of the conceptual framework. And tomorrow we will do the regulatory aspect. Then on Wednesday, we may not meet. But on Thursday and Friday, so Thursday we may do the ethical framework. Then Friday we will commit ourselves to solving past questions on the ethical framework. So that is how we are going to approach it. So by the time this week ends, it means you are ready for the 10 marks aspect of your syllabus, which means you can take any ethical question and be able to deal with it. All right. So now, one key thing I must say before I go into the content of the conceptual framework for our day is that the conceptual framework itself is not a standard. Please keep this thing in mind. It's not a standard, but it's what? It's a principle. So the conceptual framework is not a standard. When I say it's not a standard, it means that it is not an IAS or an IFRS standard. It is the foundation on which those standards are built, but it itself is not a standard. All right, so that is what we are talking about. Now, since it is not a standard, every standard overrides it. Okay, it's not a standard. So it means that all standards overrides the conceptual framework. Please take note of this. This is a very important thing you should remember all the time. Conceptual framework is not a standard, and all standards override conceptual framework. What does it mean? It means that if there is a conflict between the conceptual framework and the standard what prevails. So that is all it means. All right. If there is a conflict between the conceptual framework and any standard, the standard prevails. All right, take note of that. So the reason this becomes important is that the conceptual framework is the frame, and the door that you fixed inside the frame is the gateway. So if there is any challenge between you passing through the door, it is between you and the door itself, not the frame. All right. So what we are saying is that the door is the standard. The frame that you have done is also there. The door is fixed into the frame. But when it comes to you and your dealings with the door, what you realize is that you are not dealing with the frame. You are actually dealing with the door, which is the standard. So if there is an override or there is a conflict between the conceptual framework or your framework and the door you would want to use to pass out, it is between you and the door. What I'm saying is that if it happens so that you want to enter your room and you miss your key and it is locked, you don't uproot or you don't destroy the frame. What do you destroy? It is the door. Okay. So if there's any conflict between the conceptual framework and the standard takes precedence. So if you don't know what to apply, are you going to apply what is in the standard, or you are going to apply what is in the frame? So here we say that deal with the door, which is that the standard takes precedence. All right. So that is that. Now we're going to go into the content of the conceptual framework, and that is the purpose of our class today. We are taking it step by step, step by step. And please, anything that we do here, anything that we discuss here, like I've said, becomes the foundation of everything that we will be doing in future. So please, I need you to get the understanding from here. So if you don't understand anything, kindly raise up your hand. I'll let you ask the question. All right. So if you want to raise your hand up or do anything, you check that, you will see that on your Zoom app, what you are using, you will see some reactions. There's something called reactions is there. Now, when you look at the reaction, you click it and you see that there are some thumbs up, there are hand raised and all those things. So you just click on hand raised and I will see it from here. Then I will allow you access to ask your question. It is so because we want to really avoid the noises so that when you missed a lecture and you want to go back to listen to it, you will not be hearing some feedbacks in them. So now let's look at the real deal for today by looking at the content of the conceptual content. The conceptual framework is developed by the IASB, all right? The IASB, International Accounting Standard Board. Now, there have been so many conceptual frameworks that has been developed. So far, I know that we have 3 now, and it keeps changing. Maybe very soon, another conceptual framework will pop up. We started having conceptual framework in 1989. Then in 2010, there was a change in the conceptual framework. Then in 2018, March 2018, they changed it again. So the conceptual framework that we are going to do is the one of March 2018. That is the one examiner. So please take note of that. And so some of the definitions you've known in the 2020, 2010 one has changed. And so you need to take note of that. So there are 8 chapters in the conceptual framework, 8. And the 8 is what we are going to do. You realize that some of them are very important. And you now realize that, oh, okay, this is the reason why I make this mistake. This is the reason why I make this mistake. This is the reason why I make this mistake. All right. And please, FRCR is law. It is not mathematics. It is law. So if you miss the law, you are in a deep problem. It's like going to write a taxation question. The reason why you will add back some expenses or you will deduct some expenses is because the law says so. It is the same here. So if you miss the law, you've missed the mathematics. So get that too at the back of your mind. That is what we are going to do. There is the meaning to the figures that you'll be adding. And like I said, it is in this conceptual framework, you will know that, okay, this is an asset, this is a liability, and all those things. So get the meanings behind what we are going to do so that when you are applying it, when it comes to the addition and the subtraction, you will know what it is all about. Now, let's look at one of the conceptual framework. One of the conceptual framework talks about the objective of general purpose financial report. The objective of general purpose financial report. What is the objective? What is the reason why we need all these things? Now, the objective, the reason why you are learning this course, the reason why you want to know how to prepare account, be an accountant and all those things. Yes, I know is to increase salary. But the main reason why you are doing this is so that you'll be able to provide information about an entity. So to provide information about the reporting entity. So that is the reason why you are doing all these things. Now, what information are you providing? The information you are providing are the economic resources. You want to give information about the economic resources of the entity. And this is what we call assets. You want to give information about claims against the entity. And what do you think that one is? What are claims against the entity? Yes, who can tell me? Then the last one, you want to also talk about the efficiency. The efficiency and the effectiveness of management. Yes, I'm waiting. I'm waiting for the meaning of claims. Then the last one will be changes in the economic resources. These are the information you want to show people. What does all these four things mean? I've given you a clue of one. Yes. Please, do you want me to mention names? At least I have 3 people here and I have 3 things to also get their meanings. Yes. Yes, who is talking? Who is talking? Mr. Kwabena? Kwabena, are you there with me? Sheila? Are you there with me, guys? Julia?
We are here. We are here.
So, yes, when we say a claim against an entity, what do you think that one means? Hello? Yes, Sheila, a claim against you, what does it mean? If somebody has a claim against you, what does it mean?
Maybe there some complaints about you, about the entity.
Yeah, so if somebody has that in terms of finance or money terms, what does it mean?
Maybe financial malpractice has gone on.
No, I'm talking about money.
Money.
Yes, not issues, money.
Money.
If somebody has a claim against you, why do you think somebody will come to you for anything? Money, as a company. Yes.
Maybe you are holding on to someone's money.
When you are holding on to somebody's money, what do we call it? When you are holding on to somebody's money, see, I'm trying to let you understand from this simple back. How come you can hold on to somebody's money? The person is coming to you because of the car. True or false?
True.
Yes, that is what I wanted you to see. So a claim against an entity is liability.
Oh, okay.
So get these things. Okay, let's come to efficiency and effectiveness of management. How do you know that, like when we say efficiency and effectiveness of management, what in finance helps you to know that? What in accounting helps you to know the efficiency and the effectiveness of management?
We are talking about assets.
No. The asset doesn't talk about efficiency.
Efficiency.
Yeah, the assets doesn't talk about what is efficiency in itself and what is effectiveness in itself. If you understand it, you'll be able to know what we are talking about. So when we talk about efficiency, when we talk about effectiveness, what does it mean? Okay, so getting the meanings behind these things, like I said, is the drive for your ability to write your exam. If you don't understand the meanings of the words, all right. So please, efficiency, we are talking about how you are able to get more out of a minimal thing. Okay, and the idea to be put me produce much out of it. That is what we say you are efficient. When we say you are effective, it is your ability to meet an expectation. Okay, so you are able to meet your target. That is what we call effectiveness. So to measure this thing from management or of management, we have to use what we call the P&L. So that is what we call it. That is how you know. So this is what the information that you want to provide. You are providing about the reporting entity. And the changes in this economic resource is what we call equity. So at the end of the day, when I say the general purpose, objective of general purpose financial reporting is to provide information, and we say this, what we are telling you is that, can't you see that A, L, and E is the combination of this one and this one, helps you to prepare statement of financial position. Can't you see that? Because in the accounting equation, A is equal to what? E plus L. And this is P&L. So if we say that the objective is to provide information about reporting entity, it's just telling you that it's to prepare SOFP and P&L. That's all. Okay, so that, and it is very important to get these things, because your exams is like this. It is what is behind the words that matters, not the words that you see in itself. All right, yes, Julia, go ahead.
Please, the first one, is it enrich or what?
Which one? This one?
Yes.
Economic resource. All
Oh,
right.
okay.
So that is that. So you provide information about the entity. Who are you giving the information to? You are giving it to the investors. You are giving it to the lenders. You are giving it to creditors. See, and please get these things. This is the purpose of what we are doing. This is the purpose. So whenever we ask people of users of accounting information, their first focus will be employees, management, shareholders. Yes, shareholders may come as part of investors because they invest their money. So look at where it is coming from. It is to provide information to who? Investors, lenders, and creditors. We never said management. But overall, when you are looking at users, even the government will come in. But we are not preparing the accounts because of them. All right. These are the people that we prepare the account. These are the main reasons. Now, why are we giving them this? Because they are going to make decisions. So we provide information about a reporting entity to investors, lenders, and creditors in making their decision. And what is the decision? The decision about providing resource to the entity. Providing resource to the entity. Nti deɛ nti a prepare financial statement ni na ne sɛ yɛpɛ sɛ yɛ prepare na yɛde ma nkɔfoɔ a ɔmo sika ɛbɛbrɛ company. That is the reason why. And that is the reason why when you go to the bank, they say bring your financial statement, because they are going to lend you money. So this is the purpose of financial this is the objective of general purpose financial information. That is chapter 1 of the conceptual framework. So you see, the next time you sit in your exam and you are preparing your ratios, know who you are interpreting the ratios to. So these are the key bits of it. Know the people you are interpreting the ratios to. And in your exam, if they ask you to calculate the ratios of efficiency and effectiveness. Yes, we will do that, but understand where it is coming from. This is where it is coming from. Everything starts from the conceptual framework. If you are preparing P&L, it comes from here. If you are preparing SOFP, it is coming from here. Even cash flow, it is coming from here. The notes is coming from here. So please, conceptual framework, like I keep saying, is the foundation of everything you do corporate reporting, everything you do financial reporting. But unfortunately, some of you had exemption to skip this. And so you lack the foundation. That is why we are going back to do all these things. All right. So now that is that. Let's go to chapter 2. Any question so far? Any question? So we go to chapter 2 of the conceptual framework, chapter 2. It's 8 chapters. We go to chapter 2. Now that chapter 2 is very, very, very important because the chapter 2 talks about the qualitative characteristics. The qualitative characteristics of useful financial information. If we want to say something is useful, the information here, we are referring to financial reporting information. If you want to say this information is important, then how do we judge it? We are looking at the qualitative characteristics. All right, and the qualitative characteristics is grouped into 2. We have the fundamental and we have the enhancing. All right, now the fundamental helps us to separate useful information from unuseful information. Unuseful or useless information. Unuseful information. And the enhancing helps us to separate more useful information from less useful information. So information they've been here CB. All right. So this is the 2. Now for information to be fundamentally relevant or that to be relevant. That to be relevant. All right. Now, what does it mean to say something is relevant? Something is relevant if it is able to impact decision. All right. So we talked about the investors, lenders, providing information to the entity. So the information that you are giving to them must be able to influence their decision of giving the risk. So ability to make a difference. So we say that ability to influence. When we say to influence, that is what it means. So something is relevant if that is all we are saying. All right. And so you ask yourself, there's certain things that are around us. If I want to pursue this ICA course, there are so many irrelevant things that you have to clear off and stick to relevant things. Okay. So that decision has to be made so that everything that you are getting becomes useful. It is, and see, everything is practical, not just book. You have to stick to things that are relevant to your course. If you don't stick to things that are relevant to your course, don't expect results from things that you are using on non-useful information, but you want to get, come on, who does that? There's a lot to everything. All right. So like even in this class, if you say we are starting at 4 and we want to join a class, if you decide to do something that cannot influence your passing of your exam, then there's a problem. Yes, yeah.
Thomas, please, your voice is very slow.
Is slow or low?
Low. We can't
Oh,
hear you well.
all right. Thank you very much.
Okay.
Thank you. Let me work on that. Yes. So the information becomes relevant if it is able to impact your decision that you want to make in providing resource to the company. Now, so in the end, we said that the thing should be able to make a difference. All right, to be able to make a difference. Now, for something to be able to make a difference, we say it should have what we call a predictive value. Please, all these things, I don't expect you to write them. I want you to understand them. All right. Confirmatory value, because these things are not examinable per se in your syllabus. Like I told you, the part that we will focus on when it comes to your 10-mark examinable area, your 10-mark examinable area is this part, 10 marks. But all this we are doing will help you understand the standards when we start doing the standards. So if you don't get this, and when we get to this part, you realize that everything that we are going to do for your 10 marks is inside this conceptual framework and also this regulatory framework. So take note of that. That is where it is sourced from, and the standards themselves. All right. So at the back of your mind, just understand that there are fundamental qualitative characteristics and there are enhancing qualitative characteristics. Fundamental means that the financial statement information that you are giving should be relevant. And when we say something should be relevant, it means it should be making a difference. And when we say something can make a difference, it means it should have a predictive value and a confirmatory value. Predictive value is telling us that, oh, it helps us to use the past information to predict the future. So the past information becomes an input for us to predict an output. And when we talk about the thing having a confirmatory value, it means that what we have confirms what happened in the past. All right, confirmatory, predictive, future. All right, so these are English terms. Of course, for something to also to be relevant, we say relevance is affected by time. And please, this one is so true. It's a real life. Obi Kowaria, Sofuni Bisa say, is there anyone who has information who would want to give it out so that we don't bring these two people together? If you don't give the information as at that time, no more worry. They've already married, they will solve the problem within themselves. So your purpose of not getting them to be together because you didn't do it in time, are a foolish case. All right, so please, that is that. It's also affected by nature, and it is also affected by materiality, the size of the thing. All right, so that's that. All right, the second thing you should know under fundamental is faithful representation. Faithful representation. What does faithful representation mean? Please, the word is faithful, and the other one is representation. Okay, representation means that the thing has happened. You have presented it, you are representing it. Faithfulness means what? Honesty. All right. So we are saying that whenever you are giving a financial information, the information that you are giving should be complete. It should be complete. Not only that, it should be neutral. So you don't bring in biases. All right. And it should be free from error. So that is all that we are saying. All right. So that is that. Now, when we come to the enhancing talks about stuff like comparability, and that is what you use for your ratios, like I've said already. So you compare last year to this year, you compare budget to what do you call it, actual, which we do in man accounting. Then you compare the company to the other competitors in the industry. So you compare it to the industry average. That is the essence of your ratios, which you'll be doing for 20 marks. So please take note of that. And to be able to compare last year versus this year, or the company versus the industry, there are three things that you want to know. Number one, there should be consistency. What do I mean by that? The standard gives way for choices. So something for like depreciation, somebody will use straight line method, somebody will use what? Reducing balance. But there has to be consistency. Before I can compare A to B, both of them should be using one. You can't use reducing balance and somebody use a straight line method and you say you are combining them. It's not possible. Okay, so there has to be consistency in approach. All right. Then there also has to be issues of disclosures. Okay, you have to tell us the method of depreciation you use. If you don't tell us, we will never know. All right. Then we do the comparatives. Okay, the informations for the comparatives. And number two, under enhancing, we have verifiability. Verifiability. What do we talk about under verifiability? We are saying that two knowledgeable and independent observers could come and reach a consensus about the same transaction. What are we saying? If you bring PwC to your financial statement, they should be able to say it's true and fair. If they are able to say it's true and fair, then if KPMG comes, they should also land the same conclusion. If what do we call it? Auditors in the Caribbean, KPMG, PwC, Deloitte, and all those things. If all of them is to come, they should be able to land at the same conclusion because they should get evidence and you give them. All right. Number three, we have already spoken about timeliness. You have to provide it in time. And number four, understandability. It has to be clear. If you prepare your balance sheet and your P&L for marking and it is not clear, I mean, Charlie, don't expect us to give you all marks. All right. So please, this is chapter 2 of your financial conceptual framework. Any question? Any question? Like I said, this is not something you should kill yourself about, but get the understanding. Chapter 3 of your conceptual framework. In fact, the ones that you should be interested in the most is chapter 5 and chapter 6. When we get there, that is the part you should be interested in the most. Because we will have some discussion there. So that is that. Chapter 3 talks about the reporting entity and the financial statement. And the financial statement. Now you realize that the reporting entity, if you are doing consolidation, we have one of them is the one that is going to prepare the financial statement, which we call the group financial statement. One of them is going to record. So the reporting entity is the one that actually prepares the financial statement, but it's not necessarily the legal company. So please let me strike this one. The one who prepares the financial statement is not necessarily the legal one. It's not necessarily the registered one. No. Any company can prepare financial statement. Please take note of that. Not necessarily legal, but can be substantial. So we talk about this word, substance over form. Substance over form. Please, it is substance over form. Substance over form. And number two, we talk about going concern. Please, these are fundamentals that you should know. When we say substance over form, something happened to me recently. I was holding 200 Ghana cedis to pick a taxi from one place to another. The taxi driver said that he won't take me because my money is 200 Ghana. He won't get change. Please, did you hear me? Hello? Hello?
Please go by it again.
I said I was holding 200 Ghana cedis, and I wanted to pick a taxi from one place to another. The taxi where I was going, they normally charge 3 cedis, 50 pesos. And my money on me is 200 cedis. I told the taxi driver I'm holding 200 cedis, and he said he won't pick me. Is there value for my money, therefore? The 200 cedis, what is the essence of it if it cannot pay transport fee? It's
There
not
is
like
no value.
Yes, it's not like it can't even pay. It can pay, but because the driver says he doesn't have change, he won't pick me. So you see that I have the form, which is 200 cedis, but it doesn't have substance. So that is why we tell people that, see, money is the last on the ladder of wealth. If you go bragging with your money, can't driver and say I'm holding 200 cedis and cover family. But I did it out of integrity so that it won't be like when Nisika. But the money didn't have value. It couldn't even give me any value. It can give me value elsewhere, but in this context, it didn't give me value. So when we say substance over form, we are saying that form is the legal ownership, but the person who has the substance, which is the right, is the one who owns it. And please, this is the most important thing you should understand. Please. So you don't record something in your asset because you own it. Please listen carefully. Because this is the issue the amount for a from pa. You don't record something as an asset because you own it. But you record something in your asset because you have the right to use it. Please take serious note of this statement, because a time is coming, it is going to dictate whether you will pass your paper or not. Right is the asset, not the ownership. All right. Into no be to me lease obi asset. Now what to me a record in its financial statement. Who lease obi asset? You don't own it. You have the right to use it. So please take note of that. If you go and rent somebody's house, because you have rented the place, you can actually include the place as part of your asset using the value you gave the owner. So please, you don't own your phone because you bought it. You own your phone because you have the right to use it. So if it comes to a point where the phone is in your hands, but you are not able to use it, and somebody is somewhere in US manipulating your phone, that is why you go and spend money for them to release it back to you, because you don't have the right of using it. It's an amount for hacking your phone. All right. So that is that. Other than that, people can actually bring certain things into their financial statement. Creative accounting, many assets, buildings, not their bank a company name, or for him to give a picture. Don't forget, what are we reporting? Giving information about the economic resource. So the ownership what does it take? All it takes is to sign a document that says that you are the owner. Money may not even exchange hands. Okay, Obekacho say she inherited it. Yes. So please, accounting has moved from that. Now it is the right. So substance over form. All right. Please take note of that. So the right of an asset exceeds the form, which is the ownership, the legal ownership. Then we talk about going concern. What is a going concern? The fact that the entity will continue to operate for a foreseeable future, and they have no intention of what? Closing it down. All right. Please, if you don't add that part of the intention to close it down, you've not defined going concern. And because you don't have any intention of closing it down, that is why you can prepare your account on accrual basis. All right, accrual basis. When we say accrual basis, all we mean is that recording transaction as and when it occurs, not as and when cash is paid or received. Please take note of that. These are fundamental definitions. All right, so take note of that. So that is that. When it comes to the financial statement, I know you know the 5 financial statements. What are the 5? You know that you need to prepare SOFP, which is statement of financial position. You know that you need to prepare SPL and OCI, statement of profit or loss, and other comprehensive income. You know, you need to prepare statement of changes in owner's equity, SOCI. You know, you need to prepare what? Statement of cash flow. Then the last one is what? Disclosure notes. Or notes to the financial statement. All right, notes to the financial statement. All right, so that is chapter 3. That is chapter 3. Chapter 4 is also very important. Like I said, these are the fundamentals. Chapter 4 talks about the element of financial statement. Element. Please, we have the financial statement and we have the element of the financial statement. And please, this is where everything accounting starts from. So all those things we have mentioned help you. You see that we've described substance over form, which is very important. And we've talked about accrual basis and going concern. Very, very important. Now, the next most important thing to understand is the element of financial statement. There are 5 elements of financial statement. Number 1 is called the assets. You know, but it's just that you didn't know is what is part of the element. Number 2, once you know number 1 is asset, number 2 will be what? Liability. Number 3 is what? Equity. Number 4 is income. Number 5 is expenses. So these are the elements of financial statement. These are what you are going to record under your financial statement. And the offer asset, and then you'll be breaking it down near the NCA, I've been PP, IS 16, IS 20, all those things. So that is it. Okay, so take note of that. Now, what is an asset? What is an asset? So an asset, 3 things define an asset. Number 1 is economic resource. Economic resource. What is the economic resource? So the number 2 is control. The number 3 is past event. Please, these are what defines an asset. Any other thing you know, forget about it. So an asset is economic resource controlled by an entity because of what? Past event. All right. Economic resource controlled by an entity because of past event. Please don't learn this thing on your mouth. Understand it. Because, like I keep saying, and no, and be fail you, and I say be pass you. When we say economic resource, what does it mean? Economic resource talks about the set of rights. Set of rights. So please, it's not money. It's not money. The set of rights. Right to use something, right to sell something, right to pledge something. So economic resource is the set of what? Rights. To me, rights. So we are saying that an asset is an economic resource. So we are saying an asset is the set of rights controlled by an entity. When we say controlled by an entity, what does it mean? It also means that you have the right or the ability to direct its use. Okay, then past event is the exchange. Is the exchange that happened. So if these 3 things are not there, please, you don't have an asset. And that is why a lease is an asset. the lessee can record it as an asset because what is it? Because he has a right to use it, the right to direct it, the ability to direct it the way he wants it. And the past event is that he paid money or he signed a contract. So please understand that. Okay. And please, in the 2010 conceptual framework, they will be adding which will bring economic resource into the entity. But what if it brings economic loss? Sorry, we used to say economic benefit. What if it brings economic loss? Does it mean it's not an asset? So please, the conceptual frameworks are very carefully constructing the definitions of the things. So be careful. All right. So that is that. Now, when we talk about a liability, what is a liability? A liability is a present obligation. So please, any account. Until later on, when we want you to tell us something is a liability or not. Now, one for definition when the examiner now. So it's not just about being able to say with your mouth, a liability is a present obligation. So liability we have three ways. So present obligation, transfer of economic resource, then the last one is a past event. So it's not just about your ability to say with your mouth, a liability is a present obligation of an entity which will result in the transfer of economic resource because of past events. So you can construct this thing by saying that a liability is a present obligation because of past events, which will result in the transfer of economic resources. In the old definition, they say a liability is a present obligation resulting from past events, which will result in transfer of economic resource, embodying the economic benefit. So they will bring in something called embodying the economic benefit that you receive. All right. So they are there, but what does it mean? What does the present obligation mean? So a present obligation means that you have a responsibility that you can not practically avoid. So you have a responsibility. Remember, when we started, I called this thing claims against the entity. Claims means that obiabele claimer, it means you have a responsibility. And please, it is a present obligation when you have a responsibility that practically you cannot avoid. So please, that is it. You cannot avoid it. You cannot avoid it. If you can't avoid it, then you have a liability. So please, that is the understanding you need to get. Because later on, when we are doing IAS 37, when we are doing all the IASs, you have to understand, do they have a present obligation? Now watch this. The word is what? Present obligation. So if you have an obligation that looks into the future, you have to PV the liability. You have to do a present value of it. Please take note of that. So it's not about debia saying yenunti. And on a mode and no qua. Two exams no more tricky kitty bia. Now say kai the exams is difficult. There is nothing like it's difficult. It's just that we skip the understanding of the thing. Sometimes when I'm writing exams, I know I cannot do it. I stick to the principle, the old principles that I know. It's just that because I'm not familiar with it, it will take me time, but I can do it. It's just the time. So when I use the principle, I need to analyze the principle and be fast with it so that I can work the thing in time. It will work with me two people, but because you understand the principle, you can deduce and do something. It's better than going to sit there and as I didn't or because you didn't follow the routines. So please, the understanding is what you need. All right. So please, that is it. It's a present obligation, responsibility that you cannot avoid. All right. That you cannot avoid. What is equity? Equity is just the residual interest. Please, this one, asset is equal to what? Capital plus what? Liability. So if I want E, which is this one, I just need to change subject. So residual interest in an asset after deducting what? The liability. That is what we call equity. Equity. So what we are saying that E is equal to A minus L. That's all. All right. So that is that. And please, when we get to financial instrument, remember this. I had a fee. IFRS 9, financial instrument. I had a fee. Fair value through OCI, fair value through P&L, and all those things. So remember this definition, and we will use that. Okay. All right. So please, asset is not the physical object, but what? A set of rights. Please. And the economic resource is economic resource, not resources. This is law. We never said resources. We said economic resources. So you may have other resources, but they may not be assets. The only ones that we are referring to is what? Economic resources. All right. So please take note of that. Let me say it again. Asset is not the physical object, but what? A set of rights. I'm saying it again. Asset is not the physical resource, but the set of rights. All right. So please take note of that. It's not a physical object. Okay. All right. Now let's come to an income. What is income? So please, income is different from, understand the differences between income, revenue, and gains. They are all different. Revenue is the one that you get in your ordinary course of activity. Gain is the one that you get in your one-off inordinary course of your activity. So obi a oton nsuo sika na obenya no yefrɛ no revenue. Yenya nte expenses kwan free yefrɛ no revenue. All right. Oton nsuo sika na onya free nsu ton nim no yɛ revenue. But oton nsuo no, so decided say okay, oton apampan na nsuo ni gum na, then that one becomes gain. Because that one is not what she sells. She sells water. All right. So know when it is a revenue so that you record it as part of your revenue in your P&L, and know when it is a gain so that you don't add a gain to a revenue. So all they need to do in your exam is to mix up a gain into the revenue. So if you don't know the difference, now what finance are you now the call? Now waiting. You have to separate the gains from the revenue. All right. So please take note of that. So what is an income therefore? An income is therefore the combination of these two. And so we say that when you have an income, we use these three things to define an income. Income is an increase in assets, a decrease in liability, and an increase in equity. But this increase in equity is not from equity holders. Please take note of that. It's not money that is coming from equity holders. Not from. Let me write it well so that if you are writing, you write the right thing. So it's an increase in equity, but the increase is not from equity holders, because if equity holders give you money, it's not an income. I know you should understand that. If equity people give you money, it's not an income, it's capital. It's not income. All right. So that is that. That is the definition of income. Increase in assets, decrease in liability, increase in equity, but the increase in equity is not coming from what? Equity holders. What is expense? Expense is a decrease in asset. It's a decrease in asset. increase in liability. If your liability is increasing, you are incurring expenses. And a decrease in what? Equity. But the decrease in equity is not coming because you are distributing money to, it's not distributing money to equity holders. Put your equity holders money as not an expense, it's dividend. All right, so know the difference. Know the difference. All right, so you realize that if your asset increase and your liability decrease, automatically your equity will go up. All right. If your asset decrease and your liability increase, automatically your equity will come down. All right. So take note of that. So please note chapter 4 and chapter 5 and 6. I've already told you that those are the most significant aspect of your course. All right. So that is that. Please, any question before I move to chapter 5? You will finish soon before our time, because we are following plan. It's a plan. Then mainstream people, we won't do this because it's assumed that they have the knowledge. That's why they didn't go by this one. All right. And that, I mean, they have some kind of speed, and they fine. That is how it is. We won't go back like we are doing EFA. All right. So chapter 5 talks about recognition. And please, this recognition in every standard, it is there. And derecognition. Recognition and derecognition. Please, this is where it gets interesting. So I know, say by now also we need to tell. Okay. So that is that. All right. The criteria for saying something, you can recognize something, is coming from what we did. Relevance and what? Who remembers the last one for the fundamental? Yes, fundamental qualitative characteristics. Who remembers? I'm leaving it and I want it from you. I want it from you. Because when we say,
Relevant,
and what?
faithfulness.
Faithful representation. So please learn the terms.
And then the time.
No, it's these two things. These are the two criteria.
Okay.
The fundamental one, the time is inside relevant. All right. Please, these things, try and get them as part of your practice. No, it's like a lawyer who has gone to court and doesn't know how to say my lord. Yeah, it's part of the job. It's part of an accountant. Faithful representation, relevance, enhancing, fundamental, and all those things. It's not necessary. If you were doing FR, you will be examined on it, but here you are not examined on it. All right. So when we say recognition, what does it mean? It means capturing for inclusion in the financial statement. Capturing. And if you remember, we just dealt with the element of financial statement, which we said assets, liability, equity, and all those things. All right. So how do you capture something to say that thing is an asset? How do you capture something to say that thing should be under liability? How do you capture to say that thing should be under equity, under income, under expense? How do you do that? And here we are going to discuss something practical. So please take note of that. Take note of that. So there has to be certainty in judgment, certainty in measurement. So please, what you need to understand, like we've to me, baby, some question, start here, no. And these are part of your 10 marks ethics. Maybe this a question, this is here. And please, if you were not active, start being active. You've paid money for it. Start being active. I beg you. Yes. See, I always tell people, CA is not funny. So if you become funny with your learning, it will laugh at you when the results come. and you will cry. Whether you like it or not, you will cry. So please start being active. I say November na I'll catch up, I'll catch up. Come on. You know better. All right. So that is that. I'm going to give you an example. And right now, you know the definition of a liability. You know the definition of an asset. And so I'm going to ask you something. I'm going to give you a simple illustration, and I want to see if you understand, you have understood what we've done. Like I told you, it's not about memorizing what we've done. It's about understanding it and applying it. So I'm going to give you two examples. When I'm done with this recognition and derecognition. So capturing for an inclusion in the financial statement. If I give you a statement that somebody has a set of rights because intangible asset is not a physical object. That's why I give that warning. An asset is not the physical object, but what? The set of rights. Please, that thing, keep it in mind though, because it forms everything. Because if you think the asset is the physical object, then you don't understand intangible asset. It is not physical. So please get those things. All right. So I'm going to give you an example. Then you tell me where we should include it. Remember, we said recognition is what? Capturing for inclusion. So the recognition will give you later on in every standard, we will learn the recognition criteria. You realize that all the recognition criteria that we will give will fit here. It will fit there. So something when we do PP, we will say that recognition is what? When future economic benefit will flow into the entity. That future economic benefit will flow into the entity is what we call relevance. Because if future economic benefit will not flow into the entity, then of what difference can it make? Because see, unisika or life a different. Uosika is relevant, is able to make a difference. Yes. Somebody chatted me yesterday and I nearly gave the person some answer, but the Holy Spirit controlled me. You asked to join the special class. You said you wanted details. I gave the person details. And later on, he typed and said that I actually thought this thing was a joke because I'm in Kumasi and nobody has ever charged that price. Anyway, I have passed FR and CR. After wasting my time, that is what the person told me. Yes. So I decided to treat the person as irrelevant person because, yes, I understand. The price is different, but do you know what it means to also wake up 4 o'clock to teach? Do you know the sacrifice? So it can't be a normal thing. And plus, like we've told you, we'll be sending you your book on 20th. You'll be having free intervention. If you do, in fact, this thing is even close to the normal thing we do, depending on the price of the book and the intervention class. You realize that it's close to the same. It's just something extra for we waking up at dawn. That's all. Now, bringing it to what we are trying to say here, it has to be relevant. It has to be faithfully represented. So in all the standards that you'll be learning the recognition criteria. And you should know that by the recognition criteria, that thing is an asset. You should know that by the recognition criteria, that thing is a liability. You should know that by the recognition criteria, that thing is equity, income, expense. So it is the recognition criteria that helps you to capture the thing for inclusion in the financial statement. And when I say that, I'm referring to the element of financial statement. Asset, liability, equity, income, and expense. So what makes you think that that thing is a liability? What makes you think that that thing is a asset, equity, income, and expenditure? And please, if you know that, then you go back to your assets. If something is coming in as an asset, it is a debit. If something is leaving an asset, it is a credit. If something is a liability, it is a credit. If something is reducing a liability, it is a debit. If something is increasing an equity, it is a credit. See, that is why we put those two things at one side. These two ones, when you were learning, we said there is the left-hand side of the account and there is the right-hand side of the account. The left side of the account is what we call debit, this one. And the right-hand side is what we call credit. So all these people who are on the right-hand side have credit balance. And all these people who are on the left-hand side have what? Debit balance. So this is asset, equity, liability. So there is no way you should start exchanging this one for this one and this one for this one. No, please. What about income and expenditure? So expenditure also forms here, comes under debit. Then income will be what? Credit. So this is what you should, this one there is the SS1. Is the SS1. So if you know that the thing is an asset, now I can see crediting asset now. I mean, the only way you should be crediting asset is when the asset is reducing. So take note of that. The only way you'll be debiting these two things is when they are reducing. So that is it. Okay. So please, that is the fundamentals you need to get. All right. Now, that said, we use the financial statement approach in preparing financial statement, not the P&L approach. Okay, so please take note of that. The financial statement approach is trying to tell you that it's on accrual basis. All right, so everything you do is on accrual, and it is on in SPL approach. You even though you are using accrual, you use accrual and cash in SPL approach. All right, so P&L, use accrual, no say use cash. So when the person paid, it's an expense. If he hasn't paid and he just incurred, it's also an expense. All right, so please take note of that. So now let's talk about the derecognition. Derecognition. So you can only recognize an asset, for example, when you have the right to use the asset. Okay, then if you can measure it reliably, that is faithful representation. If the cost can be measured reliably, it's faithful representation. All right, so let's look at derecognition. Recognition is capturing for inclusion. Into derecognition, derecognition is removing it from the financial statement. Okay, you remove it from the financial statement. When do you remove it? You remove it, for example, for an asset, you can only remove it when you don't have control anymore. All right. So we said that an asset is economic resource controlled by an entity. So you can only say the thing is not an asset anymore when you don't have the control. So when control is lost. Please, I'm going to give you an example. And you realize that, oh, you realize that, okay. So what about a liability? A liability is derecognized when you no longer have what? Present obligation. So please, that is that. Now, with this thing said, please, Mr. Akwabna, if you are there, let me know you are there because I'm going to ask you a question and I want to know if you are following. And please, I discourage the habit of I won't join, I will watch the video later. Yeah, I discourage that. Join, ask questions so that when you are watching the video, you get more understanding. Now, let's look at this example, please. Exams. Look at this man, A and B. All right. You've heard of something called revenue. And you see, in revenue, you realize that when we get to revenue, I'll draw your attention, but I'm just using it as an example here to close out. In revenue, you realize that there has to be a contract. So let me not even go into the revenue standard. Let me use an example here. A wants to sell an asset to B. Now, the agreement is that when A, which is IFRS 15 anyway, when A delivers the asset to B, say the good to B, he will deliver and he will collect. So please look at this arrow. A is to deliver. Then once A delivers to B, like the way you people order food and buy things by ordering. When the asset gets to B, B will now give A 5,000 cedis. That is the agreement. That is how we buy things. Okay. So what you see here is that if this thing is a good, so if it is a good, we are no longer dealing with asset. And that is what A does on daily basis. Then the delivery of goods is any money that he will get from doing that job is called revenue or income or gain. Which one? This is what he does daily basis. He sells goods. So if he delivers to this one and gets money, that money, is it income, is it gain or revenue? Yes, which one is that? Which one is that? Hello, class.
Thomas, please, I'm not getting it.
Obi tonwade, A sells goods. And a B, abetobi, now wait you have 5,000. And I'm asking that the 5,000, will it be a revenue? Will it be a gain or it will be an income? That is my question.
It's an income.
No, it's not an income. Before we go here, I had explained to you what an income is. I had explained to you what a revenue is. And I explained to you what a gain is. Do you remember them?
At
Hello?
that time, I wasn't beside the laptop.
So you see, that is the problem. All right. So it's a revenue. So please, if that is the case, you should take time and watch the videos back when you get them.
Okay, I will do that.
Yeah. And please, the other people on the class that are not contributing, I don't know whether you are with us or not, but it serves you no good. It serves you no good to join and not listen. I mean, who are you deceiving? At the end of the day, it's yourself. All right. So that is that. So when you do that, it is a revenue. Now, say if A delivers the asset to B, what is happening is that he has done his part of the contract, and therefore he can lay a claim against B and say that B is owing him money. That is the essence. Please, and this thing I'm doing right now is exam question. Oh. This one is an exam question, but because students don't understand these basics, it becomes something very difficult for them. And that is why we separated the main class, because the main class, the truth is that we have timings and we need to run. It go back near way under conceptual framework. We will do it when we are doing the standards. And we will teach it there. So if you don't get it, you didn't get it. So here you are doing it here. You can, when we get to the standards rule, it will be there. So what in it twice? So it shouldn't be a problem. So please, I need you guys to participate and ask questions. But if you don't, well, it will sound like I am rather putting pressure on you. But come on, I am not the one going to write the exam. So please, what sacrifice and participate. Okay, I know you guys are professionals. Where you are now, you know what it takes. So the fact that if you don't go by what it takes, then it means that 1 hour decided. All right, so let me move on. So what we see here, therefore, is that once A delivers his part, B has to pay the money. If B hasn't paid the money, A will call B a debtor or the car. And you see, this is where it's coming from. Debtor. This is where it's coming from. So A does his part of the job, then B has to give him money. So if A does his delivery, then B ebedenika. Now watch this. Watch this. And this is the funny part. What if A has not delivered, but B pays the money? Yes. Any idea on that? A has not delivered the good. So this is another scenario. So A has not delivered, but B has paid the money. What do you see there? If A delivered and B has not paid the money, then it means B is owing A. So B becomes a debtor. Now, A has not delivered, but B has paid. Please, let's not make this thing book. It happens in your life. Sometimes nipa ne de ba na utiaka. Se nipa ne mfam baya untia. That is the normal okoto wacha. Wachi run enti ebiane ni mawa utiesika. So that is it. And there are times that you even give the money to the wachi run and san wachi ebiane nam. These are the two scenarios. And these are the scenarios that you are going to face in your exam. So accounting is not an abstract thing. It's a practical thing. Now you realize that if A delivers the good and B pays the money, then what is happening is that A can record revenue. A can record revenue of 5,000. So depending on, and don't forget, revenue is under here, income. So revenue is under income. We talked about revenue, income, and gains. All right. So revenue is credit, is at the right-hand side. So it means that you credit revenue, credit. So if B paid cash, then you can debit cash. A can debit cash. A can record revenue 5,000. If he paid cash, then it means that A can say cash 5,000, which is what? A debit. If he didn't pay cash and he will pay later, that is where instead of cash, you will record what? A debtor, 5,000. So that is that. All right. Now watch this. What if A has not delivered the good, but B has already paid the 5,000? It means that what the sika and therefore it is not a revenue. So in this case, it is not a revenue because you have not sold anything. You have not delivered. You have not performed the part of your obligation. You have not. And so you cannot say you have a revenue. But rather, sikana awajino becomes a loan. until you deliver the job. And if it is a loan, then it means that A should what? Credit his loan account, liability, loan, because he has a present obligation to deliver something. Don't forget, we talked about obligation, liability. It means B has a claim against A, which is the money he has given, for which he has not delivered. So liability, it will be recorded 5,000. Now, then the Sikana AG, you will now cash debit also of 5,000. See, this is the double entry. And this thing it's always in your exam. It's either they will test it under IFRS 15 or IFRS 16. So one TRC, and then the problem. All that they will do is that they will add some small interest rate be inside the question. 10%. What does that tell you? What this thing is telling you is that Sikana or G and Ayabosiano, it was so interest also interest. And so you realize that is what they will bring in your exam. You realize that the liability, there will be an interest liability. In this case, 10%. Oh, there 10% of this one, the liability will increase by what? 500 cedis because you pay the interest. And where is the corresponding entry of that 500? It will be in your P&L, interest expense, also a debit of 500. So have you seen the difference? The thing that comes into your exam. Please, have you seen it now? So this is what they will be doing in your exam, and it will be creating confusions for you, and you may not be understanding them. So please take note of that. It's very, very important. All right. Okay. So any question at this point? Because that is what I wanted to show you under recognition. All right. Any question at this point? All right. So that is that. I have small time, like 16 minutes. So we look at chapter 6, sorry, which talks about measurement. And chapter 6, measurement, it just talks about the determination of the monetary value of the event. So monetary value, how we attach money value to the event, monetary value to the event. All right, so that is that. The monetary value of the event. Okay, so here the conceptual framework gives us only two measurement bases. Two. I'm going to do. Number one is historical cost. And number two is what? Current value. All right. So the historical cost that we are going to discuss is the past event, the one that is so reliable. And on your friend reliability, in those days, because it is the money that you spend, the price, the exchange price, the price at exchange. All right. When you were buying the thing, the time you bought the price. So what happens is that at the date that you were buying the thing, the price that you pay, all right, so that is that. That is that. So it tells you that if the thing doesn't have a monetary value, you ignore it. So we are looking at those ones that has monetary value. And the monetary value determination is the price at which you purchase the thing. All right, so that is that. Now, we come to the current value, and the current value is what we call the relevance, because you don't make decision using information of the past, you make decision using information of the present. Okay, so that is where the standard talks about the three valuations. We have the fair value, which we will learn later under IFRS 13. The fair value, we are looking at when there is an active market. You will learn that, so I won't waste my time. So we look at fair value at active market, we look at fair value in non-active market. All right, non-active market. And most importantly, under fair value is also the time value of money. All right, so that is that. Then we have the VIU, value in use. That one too is the present value of the future cash flow. We will also look at this in IAS 36 again, impairment, future cash flow from using the entity, the asset. All right, from using the asset instead of selling it, you are using it. All right, which is also called the fulfillment value. So when VIU now fulfillment value, that is the meaning. All right, fulfillment value is the same thing. All right, it's the company specific. So please, when we say you are using the thing, it is company using it, not a third party using it. All right, then the last one is what we call the current cost. Please don't confuse this current cost with current value. We say current cost. Current value is the embodiment of any of this. All right. Current cost, we call it the replacement value. The replacement value. All right. So the replacement value, we are talking about how much you get for the asset if you are replacing it now at the measurement date, at the date, and yet that date, at the measurement date, at the current measurement date, how much will I get? All right, so please, that is that, and that is measurement. So if you are not going to continue the business, this thing is on going concern, under the assumptions of going concern. If you are not going to prepare your financial statement under going concern, please, you will use what? Breakup value, or the one that is popular, realizable value. So please, you realize that when we start doing business valuation, this one too will come to play. This one too will come to play. All right. And that is why you realize that in your business valuation, you have something like patent, and we will let you do annuity of it, PV of the annuity, and all those things. Yes, this is where it is coming from. This is where it's coming from. Some of the assets, it is there, you have to use replacement value. Some of the assets, you have to use, what do you call it? Realizable value. Some of the assets, you have to use fair value. So that is where it is coming from. All right. So take note of that. Then the last two chapters, then we go is chapter 7 talks about presentation and disclosures. So that one we will deal it under it, under the various standards. Okay, so disclosure standards, we talk about IAS 1, IAS 7, IAS 8, IAS 10, 24, and all those things. Then the last one, which of course we don't need to talk about, is capital and capital maintenance. You'll not be examined on it, and so there is no need. So the main ones that are of essence of all these 8 chapter items are, please go over, and if you have to go over and watch the video again, go over chapter 4, chapter 5, and chapter 6. These are the main ones. All right, so this is it. 4, of course, chapter 3 is part, but that one I don't think you have issues with it. So chapter 4, chapter 5, and chapter 6. And when we were doing the chapter 5, if you realize this example is a past question, it's there. It's always coming in your IFRS 15 and your IFRS 16. It's always there. Into Ubeti, SCBB, the sale with recourse, sale without recourse, and all those things. This is where it's coming from. All right. So, ladies and gentlemen, this is it about your conceptual framework. Any question? Because God willing, tomorrow